Okay, welcome to the video CPA today. I'm Michael Scott, I'm your host, and today we're going to be talking about taxes explained, talking about understanding health savings accounts. And really there's a lot to these things, more details than what I can cover in this short video. So if you do have a health savings account, which many people do, you need to make sure that you understand all the fine details of what's around them. So we have the disclaimer here for our affiliate marketing, and then we have the educational disclaimer as you've seen before. So let's get into it. What is a health savings account? And basically it's a health account. It's a savings account that's set up by a trustee, like a bank or an insurance company or something like that, that allows you to put certain money in there that will reimburse you for medical expenses that you pay for out-of-pocket medical expenses. So in effect, I mean, when you contribute to that account, you get a tax deduction. When you take out of the account, disperse from the account, it may be dispersed tax-free as long as it's for qualified medical expense. If it's not for qualified medical expense, well, then you're going to have to pay taxes on it. But anyway, it can be set up on an individual basis or a family basis, and you can get a deduction for it, even if you're not itemizing your deductions, which for health expenditures has become very difficult anyway to get deductions for any health costs, unless you've just got monumental costs like heart surgery or something like that. You're probably not even going to get any deduction unless you're making very little money. So this gives you a way to do it. So let's get into more detail on this. How do you qualify for this? And the number one way to qualify is you have to have what's called a high deductible health plan. And so we'll talk about that in just a few minutes. But can't be enrolled in Medicare. If you're enrolled in Medicare, you don't qualify to have an HSA. You must not be covered under other health insurance or other health coverage. So you can't. You've got this high deductible plan. You can't go out and get another plan that reduces your deductible or anything like that. Okay. And there's a lot said in this area, so like I say, there are details that I'm not going to get into here. And you cannot be claimed as a dependent on another's tax return. So be aware of those. If you meet all those, you can have an HSA. And the big thing is being able to have the high deductible health plan. There are some drawbacks to this that have come up in the last few years, and we'll talk about those near the end of this video. But what constitutes then a high deductible health plan? So the IRS has defined this, and they've divided it between the individual plan, the self-only plan, and the family plan. Okay, and they're saying the minimum annual deductible on your self-only plan has to be at least $1,400 a year. And the family plan has to be $2,800. The maximum annual deductible, $6,900 for single plan, $13,800 for a family plan. Okay, so what this means is this is the maximum limit that you're going to have to pay out of pocket. So it's not only the deductible that you have to pay, but it's any out-of-pocket expenses are added into that. Now the insurance premiums are not added in. Okay, so it's got to be a plan like that. So if you go to your insurance company, this thing's been around for a while, and they know what they're how to meet the requirements of an HSA these days. So if you want to have an HSA, you just tell them what you're looking for, and then they will go over the qualifications with you and tell you, present plans to you that you might be interested in that will meet the requirements of an HSA. All right. So I mentioned earlier that the contributions into these plans are deductible tax deductions when you contribute to the plans. But there are limitations on the amount of the deduction, or the amount that you can contribute each year. And so for a self-only coverage plan in 2021, you can only put in $3,600. All right. If you put in more than that, it's subject to a 6% excise tax, which is down at the bottom here, and you cannot deduct that. So be aware, family coverage, $7,200, and those are to cover expenditures, healthcare expenditures for that year and going forward. So you don't have to spend all that in a given year, but this money can be left in this plan for as long as you want it to. Now, if you're 55 or older, you can actually put $8,200 in, $1,000 more for family coverage, or 46 if you're an individual. But that doesn't. If one spouse is 55 or older and the other is not, these are looked at as individual plans. So the other spouse could not do that, but one of the spouses could. Okay. You can have a rollover contribution. It's permitted once a year. It's not taxed, nor is it deductible, but it can be done. And like I said, if you have excess contributions in there, they're not deductible, and you're going to be charged an excise tax. So you need to, if you make a mistake and get the wrong amount in there, you need to get it out. And so go to your trustee and say, hey, I've got too much in here. I need to get it out. Okay. All right. How to get the deduction? You've got you got Form 8889. You need to file it with your 1040, and it will basically say that you've got a plan. It's an HSA. Now, the plan may cover more than just an HSA. It may cover an MSA or something like that. But in this case, we're talking about HSAs. And so it'll say, okay, you'll say the plan's at HSA. And this is how much I spent in qualified medical expenses for the year. Okay. This is how much I put into the plan, and this is how much I spent. And so if you put $3,600 in as an individual and you took $3,600 out and it was all qualified medical expenses, you're in good shape. All right. If you put $3,600 in and took $3,600 out, and only $2,000 were for qualified medical expenses, and you went on a vacation to Rio de Janeiro on the difference, which wouldn't pay for it, but then you've got taxable income. So it's got to be, when you withdraw it, it's got to be for qualified medical expenses. Okay. All right, let's talk about some of the benefits. And there's a lot of benefits to these things. They're a good deal. My wife and I had one for a while. I'm covered by Medicare now, and so I can't be involved with one. But she had one, and I'll tell you a little bit about that. I mean, it worked very well. She actually had a credit card, so anything that we put in, we could actually pay for our at the doctor's office with this HSA credit card, because it was going against what we had in our HSA account. So the deduction can be claimed as soon as you put it in for that particular year. All right. There's a limit, as I said, on the deduction, and it's the limit on contributions. But the nice thing about it is somebody else could make that contribution for you in your name. So if you had a parent, for example, that wanted to make a contribution for you, they could, and it would be in your HSA, and it would be deductible by you. All right. So that's a good deal. So anybody can make that contribution for you. I said earlier, you'll get a deduction even if you don't itemize. So there's no looking at 7.5% of your adjusted gross income to see if you're going to be able to get any medical at all. And then there's no looking at seeing whether you've got enough money to actually itemize your deductions. Okay. Now, if you've got an employer, and this is through an employer, the employer contributions are not taxable to you. They're not included in income. Okay. Certainly, if you take them out and you don't pay for medical expenses with them, they're going to be taxable when you take them out. But earnings in the account grow tax-free. And that's true. I've got maybe tax-free, but they do grow tax-free until you take them out. And if you take them out for non-medical stuff, they're going to be taxable. Okay. Distributions are tax-free if used for qualified medical expenses. I've hit that several times now. And this is an important one because some people look at this and they say, well, let me just read it. There's no penalty for early withdrawal of funds other than just paying the tax due if disbursed for medical purposes. Now, that's kind of interesting because if you compare this to an IRA, you take an IRA out early and you've got a 10% penalty on the money taken out of that IRA. In this situation, there's no penalty whatsoever. Also on an IRA or on a retirement account, you have to take required minimum distributions when you hit a certain age. There's no requirement on an HSA. So if you're able to pick up an HSA and you qualify for it and you put the money in some respects, it's better than having an IRA account. It's because the penalties aren't there and there's no required minimum distribution when you hit the right age. So think about that. Now, let's talk about a few things, a few drawbacks of HSAs, and they're very few as far as I'm concerned. We did not get one last year. My wife did not get one, and she did not get one this year. And the reason is because when you look at the HSA compared to other insurance products, they're more expensive. And insurance companies have learned, I think, that people want these things and they'll pay more for them. And so they've upped the rates on these. And there's fees involved in these things, and fees have been going up in recent years. So you really need to look at the value of your HSA versus what you're going to pay for regular insurance without an HSA and see if it's worth it to you. And it wasn't worth it in our case, so we don't currently have an HSA right now. And then I said before, the rules governing these things can be very complicated. I've just gone over a few of the high points, basically, so that you understand, the main points of an HSA. But there are, there are a lot of details. I mean, when you get into high deductible health plans, and some of them will have a lot of preventive benefits that may come to you free. Some of them may charge, but not as much as the high deductible will. And that's usually okay, but all of that stuff, if you're going to get into a plan, you need to make sure you understand what your insurance agent is selling you. So, because they can be complicated, and so that's one of the drawbacks anyway. Well, anyway, thanks for watching. I appreciate you tuning in. If you want to take any of our courses, go to www.thevideocpa.com, where we've got our targeted tax training courses, and you can actually enroll in a course out there. If you haven't subscribed, please do so, and I appreciate you watching.